Hey everybody, it's Daniel here from Infravest. Hope you're all doing well. So, got an interesting article here, comes out from Zero Hedge, talking about US companies talking about layoffs like they never talked about before in history. I mean, the talks about layoffs in their transcripts and their earnings calls are at record high levels, record rates. So I'm going to share my screen to show you what I'm talking about here. But it's very interesting to see how the markets are still continuing to do well and rally while you're getting all this talk about layoffs, layoffs, and layoffs. So here it is. US companies talk layoffs like never before. US companies are discussing cost control, example, layoffs, on earnings calls at record rate amid a push to reallocate funds and invest in new technologies, according to an analysis by Morgan Stanley strategists. So basically, telling you there that more and more companies are talking about layoffs, and the answer that they give of why they're doing layoffs, they're gonna point it towards AI. That hey, we're doing layoffs because a lot of the jobs that we're seeing can be replaced by artificial intelligence, and we're investing in AI. So nothing to be worried about. Nothing to be worried about the demand side of things. That the consumer is feeling weakness. I mean, in the last consumer price index, I forgot to mention the earnings component went in was negative. So real wages was negative, which means what? Which means that inflation was hot and people's earning potential and capacity is getting worse off. So don't you think that the demand side of things is weakening? And don't you think that the layoffs are happening? The cost control is happening because there's an issue with demand, there's an issue with growth in the economy. But no, they're investing in AI and everything's fine. And as long as you're talking about cutting costs, laying off workers and investing in technology and AI, then great. Your margins and earnings are going to look good for the coming quarters. Projections and guidance going to look good. And you're going to see stock skyrocket, just like Nvidia here, right? Pushing up around 728, 730 bucks and continuing to rally, 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 rally. And just like how we're seeing the index, the S&P 500 and so on, all of these stocks skyrocketing. Now, moving on back to this article here, transcripts mentions operational efficiency. Okay, keyword operational efficiency are at highest ever in the US during the earnings season as companies focus on expense discipline, but also invest in technologies that can drive future productivity like AI. There's a notable overlap among industries discussing operational efficiency, most prevalently, and those that are discussing AI, the strategist says. These groups, so the groups that are talking about it the most, are the software industry, professional services, healthcare services, and financial services. Now, if you look at this graph here, we see that operational efficiencies mentioned in the earnings transcripts are at record high levels up here, right? Record high levels. And it's been rising, right? If you look back here in 2020, that wasn't the case, right? We saw a slight increase, but kind of it fell there. We saw this back in 2008 also, 2006, 2007. There was a rise, then a decline, right? Still didn't have the recession and crash. So it was rising into from 2006, from let's start with 2005, 2006, 2007, decline or everything's fine. We're not laying off anymore. And then boom, a big new all-time high here, right? And what are we seeing now? We're seeing 2022, 2023, 2024 steadily rise. then maybe things it may decline a bit, saying, "Oh, all is good, soft landing, everything's fine." I don't know what you're talking about. We're investing in AI. We just want to, push out better margins, better earnings, and then maybe we get, the level to go above the 2024 level. I mean, we'll see. Time will tell. But the major thing is that operational efficiencies being mentioned, aka layoffs, are being mentioned over and over and over and over again. Now, scrolling down in this paragraph here, the rising focus on cost controls comes as firms position to protect margins amid hopes for a soft economic landing. Well, no one knows when the hard landing will come, but yes, we are in soft landing, and no company is going to go and, lay off all or major, do crazy layoffs until the major recession comes. Investors have looked for signs of cooling in the job markets to gauge when the Federal Reserve will lower borrowing costs, although recent hot data signals Fed won't be easy anytime soon. Well, yes, the jobs data we had, the inflation data had, all hot. And now pricing of we got the pricing of interest rates expected to be in June, July of this year. Now, managing expenses has been a key theme for this season. Walt Disney said profit this year will rise at least 20% thanks to cost cutting. Hertz Global is looking to reduce cost, and Levi said the new initiative to boost efficiency will include cost cutting operations like eliminating jobs. Some of these companies are reallocating these funds to grow their business, right? So you're seeing this, right? Even Meta is spending aggressively on AI, on advancements. Amazon as well will be cautious about new investments. So the trend, right? And let's also not forget Nvidia as well, which has been talking about AI. When you look at the stock in Nvidia, it's been skyrocketing here. When you look at stock of ARM talking about AI, also skyrocketing as well. Looking at it to, jumped all the way to 160. Let's talk about Disney, right? Disney mentioned, wasn't Disney under a lot of pressure because it's been making really dumb decisions, and the stock dropped since March of 2021, down 62%. But look at it now, it's moving up, right? So everything's looking good. Like, companies are posting good earnings. Why? What's the reason? What's driving Disney to rally 40% from November, right? What's causing this move? Again, go back to this article here, right? What did it say? Walt Disney said profits this year will rise at least 20% thanks to cost cutting. Not because Disney's doing anything amazing. Disney didn't come out and do something where, it all of a sudden added more demand. It's just doing cost cutting. And a lot of stocks you're seeing out there, and that's why you're seeing the S&P 500, and you're hearing for a lot of stocks out there jump up higher and higher because they're reporting better earnings. You would think that, how come they're reporting better earnings? I thought, there was a problem in the economy. Well, they're reporting better earnings because they're doing cost cutting. And then they're adding the word AI into all of this mix, causing this euphoric move in many of the stocks and pushing the index higher and higher. So how is this all going to end? Well, if cost cutting is being done, if the theme this year is all about cost cutting, well, what's going to happen when the cost cutting is not enough to meet up with the weakness in demand? What if, the earnings projection is going to look worse off because there is actually a big crisis that's expected to come? What happens then? Guess what? They're going to come in. They're going to also talk about more cost cutting and basically tell you about all the uncertainty that they see coming ahead. which may not be good for the equity markets. Right now, the equity markets have been resilient. When you look at the S&P 500 and when you look at NASDAQ, you're seeing quite the strength and continues to be so, right? And this can definitely continue as long as there's not that crisis, that crash, that black swan event, as long as everything continues to do well and everything looks rosy and cost cutting continues to make that earnings report look good. So again, nothing to do with that they're adding more business. It's just that they're managing the cost very well. And again, what will that look like if they're unable to do so? And let's not also forget, majority of the US, majority of the businesses that employ people are small businesses. That's the Russell 2000. That's the small cap stocks, right? So when we look at the Russell 2000, it's been ranging. It's been stuck in this range. Look at this. It's been stuck. Let me remove that for you. It's been stuck in this range since April of 2022. Because, yeah, they may be doing cost cutting, but for how long? Until when? Until, you know, certain businesses may go bankrupt. And if, especially if rates continue to go higher, and if you're getting a lot of smaller business to go bankrupt, and you're going to see the Russell 2000 drop, and you're going to see that unemployment rate skyrocket. We're not talking about the Magnificent Seven. We're not talking about Meta. We're not talking about the big stocks out there. That's why you're seeing those indices move up, because those few stocks are pushing this index higher. We're talking about businesses that employ majority of America, which is the small companies, small, medium-sized businesses, aka the Russell 2000. So anyways, very interesting article. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.